Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Friday, April 11th. The first quarter earnings report from General Electric shocked the market, and not in a good way. Citing the adverse effects of the disruption in the capital markets that impeded its ability to complete asset sales and the slowdown in the U.S. economy, the industrial bellwether reported a 12% decline in continuing earnings and an 8% decline in continuing earnings per share to 44 cents. In January, GE projected its first quarter profit from continuing operations would be in the range of 50 cents to 53 cents. Analysts' consensus EPS estimate had been set at 51 cents. So GE's result was indeed a disappointment, not just because it was a miss, but because it was a big miss. GE set a drop in earnings for its financial services business, which felt the brunt of higher mark-to-market losses and impairment, accounted for 5 cents per share of the shortfall. The balance stemmed from its healthcare and appliance businesses. The one true pocket of strength was GE's infrastructure segment, which achieved a 23% gain in revenue and a 17% increase in earnings for the period. NBC Universal was the only other segment to record the double-double of a revenue increase and profit increase, up 3% in both cases for NBC Universal. Notably, revenues for the industrial segment were up a scant 1%, while segment profit declined by a double-digit percentage for GE's commercial finance, GE Money, healthcare, and industrial segments. On a brighter note, global revenues grew 22%, helping to offset the weakness in the U.S. and showing the benefits of its focus on globalization. Additionally, GE noted that total orders in the period were up 8% and that its major equipment backlog increased 41% to $52 billion. So it isn't as if customers stopped doing business with GE altogether. The latter point aside, GE delivered a disconcerting message when it lowered its full-year EPS guidance from continuing operations to a range of $2.20 to $2.30 from a prior view of at least $2.42. The new range suggests expected growth on the order of 0 to 5%, as opposed to its prior view of at least 10%. The downward revision, GE said, reflects a slower economy and assumes capital markets remain challenging. The size of GE's earnings miss in the first quarter has undoubtedly led GE to be very conservative with its outlook, since it is not in the company's nature to miss its guidance marks. The first quarter miss was embarrassing, and you could hear the recognition of that point in CEO Jeff Immelt's voice in a CNBC interview following the release of GE's results. To his credit, Immelt said he isn't in the business of making excuses for the disappointment. That is a refreshing acknowledgement, but of course it isn't making shareholders any money today. Shares of GE are down 11% as the reduced growth outlook has called into question whether GE should be trading at a market multiple. The knee-jerk answer, as evidenced by today's trading action, is no. Our contention is that yes, it should. GE had a bad quarter, a bump in the road according to Immelt, but it is still a great company that is fundamentally sound. It is one of just 5 corporations that holds a AAA rating, it has a secure and steadily rising dividend, and it is literally a global force in many growth industries.